Hey guys, Derek Long here, Quest Trust Company. Sorry we're starting a little bit late. We had a little bit of just some camera and audio issues. So I'm talking a little extra loud. Hope you all can hear me. I actually got a really special guest that we're going to be bringing on today. And one of the reasons we really want to bring him on is most of our clients are looking for different types of passive investments, right? Now, I have a lot of clients of mine that are stuck with cash. It's sitting, it's not invested, somewhere right around 480 to $500 million just sitting. So if you're attending this webinar and you're like, man, Derek, I'm one of those people, I have cash just sitting. What should I do with it? So what we did is we kind of reached out to a couple different speakers, and we found the guy that I'm going to be bringing on here in just a minute. So just a little bit about his background is they deal so much in not only performing notes. Now, when I think of a performing note, I'm thinking of an active note. If you're ever down in the mortgage industry, this is those A-class individuals. This could be you having that first lien position, lending your funds out directly to either a fix and flipper or maybe a longer term note, one of those mortgages, 20, 30-year notes. But not only that, he can also deal in non-performing notes. And he can buy them off the market, which is really unique. So this, we're going to be bringing on a friend of ours by the name of Chris Seveny. So Chris, are you with me?
Yes, I am. Thank you, Derek.
How did I do on the pronunciation of the name?
Perfect. So
really awesome.
Yes.
Awesome. So I don't want to give out too much about your background real quick, but I appreciate you coming on. I do apologize for us starting a little bit late, but I'm going to kind of let you take it away, and I'm going to be here in the background to answer any questions as we kind of proceed and go through things. Okay?
Yep, sounds good.
It's all yours.
Okay. And for people also, if you have questions, feel free to put them in the comments or chat. As Derek mentioned, one of the things I wanted to focus on today as a note investor, because I get asked this question all the time, is are there low dollar IRA investments? And that's what I wanted to focus on as part of today's presentation. Before we get going, a little bit about me. This June will have spent 25 years in the real estate and development background. I started back in the late 90s working for a general contractor and a real estate developer for the last 10 plus years. It wasn't until 2016, though, that I actually realized note investing existed. So even though I spent years in the space in real estate, I didn't know this type of investment was available. And since that time, just over 6 years now, we have acquired over 500 notes, and we typically have about 250 active at any point in time. And we mostly run a lot of these through Regulation D offerings. But as I started to see more clients invest, especially people who put IRAs together for their children or grandchildren, we were able to offer additional opportunities for people. A little bit more background, my education, I've got a civil engineering degree and a master's in real estate. And also, for those that may have heard my name, I do host a podcast called the Good Deeds Note Investing Podcast. So today we're going to talk about the power of partials. And what is a partial? Some people may also hear it called a hypothecation of a note, but a partial is when an investor is buying into an existing mortgage or deed of trust with a note. And one of the key areas is, it's secured by a hard asset, which is real estate. For those that have invested in notes before, you're probably very familiar with it. If you have not invested in notes before, one of the things I think of is you're not buying the property, you're the actual bank. And with a partial, you're only buying a component of that full note, which we'll talk about a little bit more. Like any type of investment, I do want to let people know that due diligence is key no matter what you're investing in. It's extremely true in real estate and note investing as well. When you're buying a partial note, few things that you want to make sure you understand is the loan performing? Meaning, is that borrower making their payments on time? A lot of notes that are out there, investors buy on secondary market, are non-performing. So you want to make sure the loan is performing. You also want to make sure the property has equity. And what we mean by having equity is if the property is worth $150,000, you want to make sure the balance on that loan is less than that amount. So the loan to value is less than 100%. Another component that I feel is important with partials is making sure your lien is in first position, because You also want to make sure not only the equity, but there could be multiple liens on the property. A lot of people will take out a second mortgage, especially in today's world where people's equities have increased significantly over time. But when you're in the first position, it's a lot more control because you're at the front of the bus than being behind somebody. And the last is the collateral is clear, meaning there's no title issues on this property. In the note space, contrary to what most people probably believe, there's a lot of assets that actually have title chain issues, especially that you potentially may see on the secondary market. Now, as an investor, and you're being passive in some of these investments, how do you know whether a collateral is clear? Usually somebody with a partial will have a report done by an attorney that shows that it is clear title, as well as also a title insurance policy. So it's in any type of investment, everyone's always, hey, this is great. And there's that honeymoon phase when you're working with somebody, but things always get interesting when things potentially could go wrong. And when you're investing in a partial, there's two ways you can invest in a partial that we'll talk about through this process. There's one area where you team up with an investor and they do all the work. And we'll talk about what that means as we answer these questions. And the other is where you can buy a partial and the investor turns over all the work to you. Now, with most of the investors I've worked with who typically use their IRA money, they want to be more on the passive side. So they're not the ones who want to be making phone calls or chasing that money. They want to be the ones who are getting that steady monthly stream of income within their bank account. So when we do our partials, that's typically what we do is we take control and keep the partial investor informed, but also if there's major decisions that need to be made, of course, they're made part of those decisions because they are a partner in the opportunity. So if you're buying a partial, you're expecting to get monthly payments coming through every month, just like you're, a borrower paying a loan payment. But what happens if that loan goes delinquent? That's the number one question we always get asked. And it's something that is part of the contract that you sign with the investor. You want to make sure it's clearly delineated what happens. And in most instances, there'll be a grace period that allows the investor to get things on track, or the investor may, out of their pocket, front that money to continue to pay you, which typically is what I see most investors do. Because to avoid being delinquent on those payments that come in. The next could be is what if the loan is paid off early? If you're buying a partial, if you're buying 50 months of a payment at $200 a month, and the total note had 100 payments left on it, you're buying half those payments. What happens if that borrower in month 10 pays off that loan? And this happens more frequently than you would expect. And one of the reasons that does happen is a lot of these loans might be at a higher interest rate, say, 6 or 8% over the last 5 years. Rates have been, today they're 5%, but previously they're 3 to 4%. Borrowers might be able to refinance and pay those off. So what happens is the contract should have an amortization table that outlines every month how much you would get paid if that loan would get paid off. Because when you're buying a partial, just remember, you're buying that payment stream, and it's just like a loan with an amortization table. You're going to be getting principal and interest payments over a course of so many months to pay that down. Like I mentioned earlier, how loans could be split. Who is managing the loan? This is very important to understand. Like I said, the way we've managed partials in the past is we keep them in-house. Right now, we have over 75 active partials with investors. And the reason why we like to manage them is if a borrower's payment was due on the 1st and the payment didn't clear till the 2nd or the 3rd, and there were several of them that did that, I don't need to have 3 or 4 phone calls from investors saying, what's the status, what's going on? So that's where we like to manage that process. But also if they were managing it and the payment didn't come in, typically they're not as experienced a note investor as I am, and they wouldn't know how to communicate with the servicer or any of that process, the first thing they would do is pick up the phone and call me, and then I would have to turn over and take over that management aspect of it. So it's key to understand with partials, who is driving the bus. Are you giving the money to get those payments, but a part of the decision-making process if it does go delinquent? Or are you buying a partial that is being given to you for you to go manage? Those are two very, very different things. And I just want to make sure people understand that. Which that also relays into the next component, potential for additional fees. If the borrower does go delinquent on a partial, and you have to attorney has to send a demand letter demanding the payment. Those typically cost $100 to $150. And if you have an IRA investment that's, a $5,000-$6,000 investment, $100, it's a good percent. It's a percentage of that money that you wouldn't have expected. So that's something that you want to make sure it's in the contract for who pays those. Typically, in most agreements, depends on if the investor is holding on to it and not turning over management to you, they will be responsible for those fees and any additional fees like the loss mitigation if it's required as well. So it's very important to understand that, as well as the servicing costs. Servicers typically will charge around $20 to $35 to service the loan. You want to make sure in that contract agreement who is paying that fee. Is your money that you're getting net of that? So it's already been taken out. So your amortization table already shows that. Sorry. So you want to make sure, all these costs, because you don't want to sign a partial agreement for $200 a month and then realize, I was only getting $165, because that would have severe impact, of course, on your returns. Also, how do you get paid? This is an important one. Is it the servicer, the investor? And does that investor wait till the borrower gets their money? Now, one thing to remember with mortgage notes is typically there should be a third-party servicer who collects these payments, and then they will then distribute them to the investor. Now, does that servicer send them to you, or do they send them to the investor to send to you? Now, throughout this process, there is a time frame involved. So if the borrower's payment's due on the 1st, they pay the 31st, the servicer may not pay that investor till the 7th. And then the investor, if he's paying you, are they waiting till they get that money, or are they, advancing it or paying it to you on that 1st? Like I said, a lot of the larger individuals I know who sell a lot of partials, if they have an agreement with you that says you're getting paid on the 1st, you're getting paid on the 1st, and they will typically float if that payment does come in a week or so later. Again, it's something to definitely understand how that plays into account. Of course, we've been talking about contract terms, and what is the contract as part of a partial? A lot of the agreements are a contract with a collateral assignment that does not get recorded. And when investors ask me, can they record a document at their liking to go on record? There's pluses and minuses with both of that I mentioned. One is it's a recorded document, so you have a lien interest on that property. But I also will tell people, if you have somebody come replace your roof, you don't record any document with, for that process typically. And the reason why I tend to lean towards not recording a document is if the borrower were to ever challenge the validity of the loan, they will challenge the validity to everybody who's on, who has a recorded interest. So if you bought a partial from me and had a recorded collateral assignment as part of that process, then you would potentially be at risk or being somebody named in a lawsuit, which is the last thing you would ever want to happen. Now, I have never had that happen, but the potential is that potentially could be there. Also, if there is loss mitigation where you have to send a demand letter and other things, the costs will increase because there'll be multiple potential for multiple plaintiffs named in that suit. So it does, again, get asked a lot, and it comes back to the trust and understanding, the investor and really their background and a lot about them. The other component we get asked a lot by investors is, can this be done with contract for deeds? There's a lot of seller financing that is also done on contract for deeds. And the answer to this question is yes, it has been. I've done them on contract for deeds as well. A contract for deed is slightly different. We're not going to go into a lot of details today on what a contract for deed is, but it is a security interest with a loan where title remains with the lender, but these can be done. And of course, the question everyone asks, besides all of these, is what's the downside? What's the risk involved in this type of investment? Because every type of investment does have risk. The largest risk, in my mind, is the investor themselves, and understanding the background and the financial status of the investor who is selling you this partial, and asking them, okay, what are you doing with this money that you're selling me as partial? What are you doing with that money? Are you reinvesting it? Are you going on a vacation with it? A lot of investors will take that money to reinvest, or they might use it for other cash flow purposes, but a lot of them also may not, and that's where you want to be careful, because it could cause issues down the line. The other issues that we talked about is if it goes downside, loss mitigation. Has that investor ever had to foreclose on somebody? Do they have an attorney? Do they have the servicer? What is their team made up of as well? It's very important that you understand the entire team is part of the process to make sure that the investor does have that experience, that if things were to go in an opposite direction, that they have the experience and the know-all how to bring it back to a performing loan or exit the deal to get you your capital back. Now, one of the benefits of being on the with a partial is typically the loan to value that you have is significantly low. So, and again, we're talking about low dollar IRAs. Again, if I had my daughter who, was doing some work for my company and was able to give her, start an IRA for $6,000, and she wanted to go buy a partial with somebody, it would probably be a $100,000 property we would anticipate, with a loan that's closer to maturity. So it's got a lower balance that she could be involved in and get that cash flow. And typically at those price points, it's very limited where you would actually see a default. The largest thing you'll typically see is the loan getting paid off, which can have a little bit of negative consequences that we'll talk about the pros and cons in a minute. Actually, we'll talk about those right now. Because if it does get paid off early, that money goes back into your, Quest account. And if you do another investment, there's fees involved, with every IRA investor. So, a few questions are there companies where you can buy partials from? Yeah, typically you'll want to reach out to note investors. And there's Facebook groups about note investors that you can find online. Always make sure that when you hear somebody's name, that it's somebody who's actually invested with them. Because what happens a lot of time is, you'll hear a name get tossed around, but it's not somebody who's physically invested with them. Just because, you may be the best, somebody may be the best marketing person, doesn't make them the best investor. So hope that answers your question, Jen. But some of the pros and cons with partials. The pros, you get a monthly stream of income. That is basically a principal and interest payment to you as the investor. So not only are you getting that interest, but your principal is getting paid down every month. So the amount of equity you have in that deal continues to go down. Think of a car loan. If you have a loan on your car or your house, every month you're paying a principal and interest payment. So that amount of that's owed continues to go down. There is a low barrier of entry with partials. This is one of the major benefits compared to traditional hard real estate. If you wanted to go buy a property that was, $10,000, good luck finding one. But if you did, it's probably going to be in dilapidated condition and need a lot of work, or be in an area that could be, a heavy crime rated area. Whereas I've had partials before, and I'm in Virginia. I've had them in areas of Virginia on properties that were several $100,000s. But again, the loan was closer nearing payoff, and I had investors come to me looking to get into a partial, and that allowed them that low barrier entry, because loan balances can be low for a lot of notes that people have. Some of the other pros is a lot of the contracts will have I'll call it a warranty / asset equity. And what I mean by that is, in the case of a default, typically the partial, the person you've teamed up with, you'll have some type of language in there that they'll either pay you or they'll pay you off at a certain time. But you also have that equity that backs that asset, meaning the property is worth a lot more than what is owed. Now, any type of warranty really goes down to the investor themselves, and are they a man or woman of their word? But there's contractual agreements that are in place that could, hold up in court. But let's be honest, on a low dollar investment, is somebody going to pay, the court costs involved? Most likely they may not, unfortunately. And this is why go back to that due diligence component of really making sure you understand who your investor is. And the last that I think is very important, typically there's no hidden fees or additional out-of-pocket expenses if you're allowing that investor to manage it, that they handle a lot of the work and so forth, because in those agreements, they will typically be responsible for those out-of-pocket expenses. So they are taking on some of the risk involved as well from that perspective. Now, some of the cons with partials, there's a lot of pros. There's also, of course, cons that are involved. You're relying on one asset. If you invest in a fund or syndication or some other type of investment, it might be a pool of assets. Where here, it is relying on one asset. And that's why it's very important, like we mentioned earlier, to look at the assets which do have some loan to value. Another con, some people view this as a con, is your principal is being returned. Again, in some other types of investments, they might be interest only, where they pay a dividend or a preferred return. So let's just say you had a $10,000 investment at 8%. That's $800 a year divided by 12. $65 a month. But here you're getting that principal and interest back. So you're getting that, we use the 8% on the money every month, but the amount of principal goes down. Now your payments monthly would be higher. But if you spread it out over time, there is some differences by getting the principal and interest. Your returns, again, typically would be lower because the amount of risk involved is typically less. I will say partials, typically 6 to 8% is where I see a lot of the partials, and investors sell partials to investors. 3 years ago, you could have been double digits. But I think everybody has recognized everything has gotten more expensive, and returns have gotten a little, compressed over the last several years. I had partials, like I said, 3-4 years ago that we were in, 10%, a little even higher to some investors. And, over time, because our costs to acquire these assets will show some case studies in a second, illustrate that compression where things have gone. Another con that's, again, this depends on the individual, is hold time. Typically, a partial investment will be anywhere from, I'd say, 4 to 6 years. is where to get that amortization table paid down. Now, some investors love that because it's like, hey, it's one investment. I don't have to worry about finding another investment for 4 to 6 years. And again, with some of these low dollar investments, unfortunately, you are limited to what you can invest in. So having that money tied up for that period of time isn't a bad thing. I know other investors who may have $100,000. They like to sometimes have more liquidity to move investments from one to the other. With partials, it's a little more troublesome to do that. Now, you can work out agreements with the investor if you did have to, exit the deal early. And I've known investors that have allowed people out early, or there might be some type of penalty involved, but it's all about that conversation up front. That's something that you'd want to make sure you discuss up front with them. And then the last con, as I mentioned, if that note gets paid off early, there's fees involved with every IRA custodian. So it's one of those things where if it gets paid off 6 months and then another one gets paid off, in 6 months, it can be very challenging because it gets a little fee intensive where you thought this was going to be 4 years of the money coming in the door. So there are ways to work with the investor, potentially in the IRA custodian, to allow for a substitute loan that if one gets paid off, you can substitute it. And I've seen that happen previous as well. Question came through: what is the minimum you can invest on a note? Backed by real estate, for partials, I would say the lowest typically is around $4,000 to $5,000. Now, I've seen people write notes on land for, I've typically don't originate loans, but I've written a note on a piece of land that was just a vacant piece of property that we had for $2,500. So you can do that on land and other types of assets as well. It really depends on the value or the price that's being paid. So one of the things I wanted to really show everyone is a case study or example. And this was an actual deal of a low dollar partial that we've done. And I'm going to show 2 examples of how the investor and the, I'll say the sponsor, can structure these deals. And the first is, it's a home that's worth about $100,000. It's got a first position note that only has $7,500 remaining on it. And it's at 10% interest, and their payment's $200 a month. So if you amortize that, that's 46 months remaining. So the investor, meaning myself or the sponsor, I buy that on the secondary market and I pay $6,000 for that note, which will get me a 12% yield after paying the servicing costs. And again, the way I like to think of partials is, think of a train, and you got the locomotive and the caboose. The locomotive's the front of the train, the caboose is the back. The IRA investor steps into the locomotive, and then I, as a sponsor, step into the caboose. So there's 46 payments remaining on this loan. And how we structure this deal, and that's what's wonderful about partials as well, is you can structure these in a conversation and be very flexible. So in the first example, I was giving the investor $180 per month, and at 8% for 39 months, which is $6,000. If you put that into amortization table, $6,000, 8%, $180, base comes out to 39 months. And the 180 is the 200 minus that servicing cost. So essentially, I'm giving the IRA investor, all the money. And someone say, well, why would you give them all the money? And the answer is, well, I'm getting my $6,000 back that I could go also reinvest. But when you look at the caboose, I'm also getting 7 payments at the end, because the investor is getting 39 out of the 46. I'm getting 7. So I'm getting, after servicing, 14, I'll just use rough numbers, $1,400 in, little over 3 years' time. And people may say, that's not a lot of money. But like anything, real estate is a long-term play, and you grow wealth slowly. It's not a get-rich-quick scheme. But all of a sudden, if you take this and multiply this by 50 of these, and now all of a sudden you have 350 payments at $200 a month coming in 4 years from now, you can see that, where it's coming from. And as an investor who sells partials, to pay the investors, you set up in your bank on ACH, just, put it in first of each month, it goes out. There's not a lot of heavy lifting on our end, just managing that note. So in this instance, it's a win-win for both parties. The sponsor gets 7 months on the back end, and you as the IRA investor are allowed to take that $6,000 they had and get 8% on it over the next 3+ years. So it's a win-win for both individuals. Plus, again, you're backed by something that's a secure, real asset. So what if I, as a sponsor, was like, I don't want the payments on the back end? Is there another way I could structure this? And there is. Same exact deal, but instead of taking 7 payments on the back end, what if I essentially sold the 46 payments to the investor, which is pretty much all of them, for $7,000? But you're not, essentially you're selling them the note, but managing it for them, but you still have those responsibilities. And again, why would somebody do this? Because I'm collecting $1,000 up front, and $1,000 divided by 6,000, that's a 16% return. So as an investor, typically on performing notes, I'm trying to buy them at 12%. I buy some at 10, some at 14, but rarely, they're typically between 10 and 12. I can strike a deal where I turn 12% into 16% and then continue to give you the payments, and you're happy again at that 8%, because you can go on, do whatever it is you're doing, and basically just watch that mailbox money come in the door. And then if something were to go wrong with it, again, the communication would perceive you're not responsible for any costs. The investor does take on that risk from that perspective. So those are 2 examples. And if people have questions, again, feel free to put them in the chat. But this is, with partials, an area, like I said, where a lot of people have, $5,000, $10,000, $15,000, or even $25,000 sitting on the sidelines. So how is it that you can, invest this? Question that came in: do you have to have an SEC license to pool investors for mortgages? So partials, if the investor, let me be clear, investors should only have one investor for one partial. The moment they take on 2 investors, then you start getting into potential SEC issues. I am not an SEC attorney by any means. I have done Regulation D, 506B and C offerings, so I'm familiar with pooling money. But the way I've always pooled it is through those types of offerings. But as we kind of talk, that actually, Richard, rolls into the other type of investment that I wanted to talk about, which is Regulation A+ offerings. And this is still somewhat of a new term because it was established in 2015 by the Jobs Act. And many of the investors that I talk with, are very familiar with the Regulation D, 506B and C offerings. And in Regulation D, a 506C offering, C as in cat, you have to be an accredited investor. And in a 506B offering, you have to have a pre-existing relationship. So it does really separate a lot of investors. And the other component to it is the minimum offerings on a lot of those funds are $25,000, $50,000, or $100,000. So investors who have, IRA money sitting on the sidelines, can't play in those spaces because they might not have enough, they might not have a pre-existing relationship, or they might not have be considered an accredited investor. So the SEC came out with Regulation A+, which is really like a mini IPO, is what it is. And it started in the first year with about, I think, around $70 to $100 million of companies who started creating these offerings. And in this upcoming year, they're projected to be over $2 billion. And at the beginning, a lot of these firms that were doing this were equity-based deals that were investing in startup companies. So people have heard of crowdfunding that you may have invested in portals. And crowdfunding has like a $5 million maximum raise. Regulation A+ offerings allow for $75 million within a year. So it really took, crowdfunding, put that also kind of on steroids, essentially. And like I like to call it, a step above the 506B and C, because those are actually exemptions where a Regulation A actually does get submitted to the SEC. And it's typically done by what's called an offering circular, or a 1A. For those who invested in Regulation Ds, you'll hear about private placement memorandums, which is about a 40-page book that gets the investor rights that really outlines everything with the fund. It's very, very similar, but it does get reviewed by the SEC. So there are a lot more, there's another review process that goes on. In the Regulation D offerings, those don't get reviewed by the SEC. The A+ does, and the SEC does not approve anything. They qualify that offering, is the term that they use. So as we talk about some of the pros and cons of these Regulation A offerings, and let me just step back. So it is pretty much a fund. So it's, it is a type of fund, but here are some of the pros there are disclosure requirements by the SEC that include audited financials and semi-annual reporting. So what that means is there is another level of scrutiny because all this stuff is public. With a Regulation D offering, that stuff is, you can review the financials and so forth, but with a Regulation A+ offering, it has to get submitted to the SEC. So think of similar to, a stock you may buy, essentially. It gets submitted. Regulation A does get submitted twice annually. So you can actually see the financials of how that company is performing. The securities are not restricted. So it is considered a security that you'd be investing in. But what it means by not restricted is it's transferable. Typically, they'll have a lockup period, which we'll talk about the cons. But let's say you had an IRA that invested in a Regulation A+ offering, and you had another investment you wanted to move to, and Uncle Sally was interested. You could actually transfer those shares over to Uncle Sally and then get your money back to go invest it. Here's the biggest one, I think, in my mind, is it's available to anybody. Accredited, non-accredited, and it can be advertised. So that, to me, is the largest pro out of all of these, is it's open to everybody. Now, if you are non-accredited, there are some restrictions about your net worth and your annual salary that you make of how much you can invest, but there are allows for everybody and anybody to invest. And another pro is a lot of them will give a preferred return to investors. And if it's set up as a C corporation, and again, I am not a attorney, a tax specialist. I'll tell you what I read on Google is C corporations, because of the double taxation, typically don't fall under any UDFI or UBIT. I've had investors in the past who have invested in some Regulation D offerings that are set up as LLCs, and they invest in notes and real estate, and all of a sudden they're taking out loans for some of the properties or assets that are in that fund, and they're trying to figure out, getting their K1 statement, how much is, what their UBIT is and so forth, or UDFI, all of that. In a lot of these instances, you're issued a 1099 dividend, just like you would be a stock. And also, and again, always talk to your tax advisor, but from what I've been told is it does not impact any of that UDFI or UBIT. Some of the cons are, for the sponsor, there's more upfront costs. So it takes a little longer potentially for them to make, some of their money back. But it's a pro for you as an investor because it means the person's serious to do this. When we say upfront costs, you're going to easily spend over $100,000 putting one of these together, between setting up with an attorney fees and everything along those lines. So that investor on a typical Regulation D offering, you can get those done for 10 to 25,000. A Regulation A offering is 75 to 150,000. There's additional, again, I'll call it additional reading, because the offering circular is a little longer than a PPM, but it's actually more information. So you can weigh that as a pro or con. And again, I think I would look at it more as a pro, because there's a lot more that has to be divulged in these offerings, because if it's not, the SEC is going to come back and ask that question. Longer lockup periods. Lockup periods, I'd say, are similar to a partial, where you're going to be locked up for with your funds for probably 4 to 6 years as part of these offerings. No voting rights. Depending on the type of offering you invest in, there may be some voting rights involved in these types of offerings. You're investing in a private company, so that's just one. And transparency, because of the sheer volume of the number of assets. The information that's out that might be provided, because it's so much, is going to be more challenging to understand all of it, especially as they submit those reports to the SEC. It's a balance sheet, a cash flow statement, profit and loss statement. If you're not familiar with a lot of those statements, it can be a little cumbersome. But the main question is, the most investors, am I getting my dividend? Am I getting my payment, whether it's monthly or quarterly? And what we're starting to see is more note investors starting to lean a little bit more towards these Regulation A offerings to scale, because of the amount of money that is sitting on the sidelines with investors who might not become accredited or who are not accredited or have lower values. I say on the Regulation A offerings, the minimum investments typically will range anywhere from, some are $100, some are $500, some are $2,500, but we're not talking 25 or 50,000 like you are on some of these other Regulation D funds. You're looking at investments that are significantly lower, where, like I said, it's $500 or $1,000. And if you've got a low dollar IRA or some money sitting around that you can't find investments for, it is a great alternative to invest in these types of offerings, especially ones backed by notes, because again, they're also typically secured by real estate. So people have questions, feel free to put those in the chat. Somebody did ask about my podcast and so forth. Here is my contact information. Our website is 70investments.com. Again, it's the Good Deeds Note Investing Podcast. We do have a Facebook group called Notes and Bolts from the Good Deeds Note Investing Podcast, where we've got about 2,000 members, and we share a lot of information. And with that, I will turn it back over to Quest, because I believe there's also some Q&As.
Absolutely, Chris. So thank you. So notes for me is actually one of the most interesting topics. It's actually how I got started in real estate. Is my dad would partner me on a bunch of different notes, and then I kind of got to experience it. So just on your side, obviously, I know you said like, hey, some people are asking about the minimum investments and stuff like that. But right now, if someone says, hey, Chris, I have some money sitting in my IRA, what is the best way for them to get in contact with you specifically?
I'm sorry, with me specifically?
Yeah.
Yep. Email me at chris@70investments.com is the best way to reach me. Or you can, again, go to our website, and we have a contact button there. You can also set up a call with somebody within our staff on a website too, that can discuss all options that we have. Or I just like talking to note investors and sharing stories and hearing what people are doing, because it's a very unique space that there's not a lot of people who are in the space. So when you find people who are interested in notes, it's always fun just to chat and see what they got going on, share stories, but also you always learn something new when you talk to a note investor.
Yeah. So real quick, what I'm going to do, Jen, we had just had a question pop up from her about your info. I'm going to type in your email right here, Chris, and then I'll post it on the screen for everyone. What is it?
Chris, CHRIS, at the number 7, the letter E as in Edward, then the word investments with an S at the end, .com.
All right. Perfect. So,
There we
guys,
go.
that's the best way to get a hold of Chris. Now, Chris, your podcast a little bit because, like you said, notes is a very unique space. When we
Yep.
think of, like, just note investing in general, have you ever bought any of the partials? We have a lot of people that are always looking at buying just a partial note because it can be cheaper, whether they're
Mhm.
buying payments on the front end or the back end. Do you
Mhm.
deal with that very often?
Yeah, we'll sell a lot of partials because when we're typically buying, we're buying in bulk.
Okay.
So we might be buying a pool of 30 to 50 notes, and there might be some that have performing assets and non-performing assets in there. And we've had investors who have come along and said, "Hey, look, can I have a partial? Or I only have this much to invest." And we try and work a strategic relationship to have it be a win-win for both sides, and continue to build that relationship with investors.
Awesome. What about on a foreclosure rate? So someone asked a question briefly about just, hey, on your notes, do you see a lot of foreclosures in your area as far as for the location of the notes that you're purchasing from? Now, the way I'm taking this is
Mhm.
I'm going to kind of change the question on state-wise. Are you guys
Yes.
looking at notes in Texas? Are you guys looking at notes in Oklahoma? Because California, that could vary on the foreclosure aspect.
Yeah, most of the notes we buy are in, I'll say, the Midwest and Southeast.
Okay.
And the foreclosure over the last few years, very well, assume that there was no pandemic that would
Of
allow
course.
you to foreclose, because of course nobody could foreclose. Well, actually, I take that back. In non-judicial states, you still could in some, but
Yeah.
typically very rare. And what the ones we've had to foreclose on, typically they're vacant properties. That the family or there's get no longer living there and just walk from the property. One of the reasons why I believe we've seen a significant decrease in foreclosures is home values and equity have skyrocketed over the last 4 years. So people who may have had very little equity 4 years ago have a lot more equity today. So what I see people doing is, bankruptcies have ticked up a little bit
Mhm.
because, look at yourself right now where you live. If I had to go move right now, I'd probably be paying more in rent than my mortgage. If I could get a mortgage, where am I going to find a place? Because there's no homes on the market. So, where I'm living is probably best suited. And that's where also with people who have fallen behind on the non-performing stuff, it's been much easier to get them to reperforming. But on the performing loans over the last few years, we have not seen. A lot of people thought there'd be this big blip because of the pandemic. Our delinquency rates did not really blink an eye on our performing portfolio compared to historical numbers over the last few years.
Awesome. Well, Chris, you've been a good friend of ours. I know that's not the first time you spoke to us. I know we had a little issues in the beginning. That's why I wanted to jump back on and thank you. Are you going to be coming to any of our up and coming events like the Quest Expo or the Cinco de Mayo event or anything like that?
So one of our representatives, Lauren Wells, will be heading down to Quest Expo in September. So she will be coming down. I have a wedding that day, so my sister-in-law is getting married. So unfortunately, I won't be coming down, but Lauren will be in attendance. And Lauren runs our strategy. She's our VP of Investor Relations and Strategy. So she handles a lot also of the communication with investors and really determining what is best suited for them for types of investments that we manage.
I'm always torn on weddings because either they can be really fun or they can be really boring. So I hope it's a fun one for you.
Well, it'll be a small one, but yeah, it'll be fun. So thankfully we don't have to fly across any part of the United States to go do it. It's it's going to be local. It's going to be in Georgetown, part of DC. So it'll be a good time. So we can get there in like 15 minutes from our house, which is nice.
Well, Chris, thank you so much for joining us today. I just wanted to talk a little bit about some of our up and coming events. So if you just want to hang on, I'm going to talk to you right after the event, if that's
Yep,
okay.
that
Okay.
works.
But I'm
Thank
just
you.
going to go ahead and just add one of these little things right here is because, guys, if you are out there listening and you did like this class that Chris was talking about in notes, one of the things that I think a lot of people miss is the networking side of things. And Chris, I think you would agree that that's usually the best place to find your next investment. Would you agree?
Absolutely. Definitely want to go to networking events and meet with people.
Yeah. So what we're going to do is we're actually doing what we call the Cinco de Mayo event, right? Cinco de Mayo. Woo! So happy hours here on Quest. It'll be Thursday, May 5th from 4:30 to 7:30. Come and have some margaritas on us, guys. Right? It'll be right out there at one of our 600 North Shepherd Drive. So I do hope to see you there on May 5th, which is just a few weeks away. And then lastly, don't forget about the Quest Expo. You know, if you guys do want to attend the expo, all you got to do is send us an email, email marketing@questtrust.com, and we'll go ahead and get you an expo ticket right away. It's still early bird pricing, and there's going to be about 800 to 1,000 people attending this one. So I hope to see you guys there. And overall, guys, I really do hope you enjoyed this class from Chris. So Chris, thanks again. And everyone, we'll see you around. Chris, don't go anywhere.
Yep. Thank you all.